Every year, KPMG comes out and gives their predictions around what the market will do in terms of price appreciation or price declines. They've just come out and suggested maybe we're going to see growth in 2025, but in 2026, when most people expect the market to collapse, they think markets will actually go much higher. If you're interested in what my thoughts are, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, right now, predictions are a big thing. Nobody really knows what's going to happen, but KPMG comes out every year and suggests a few things that I think are very notable. After reading this report, I wanted to bring you guys some value. So let's dive into it and break it all down. So as the new year commences, KPMG analysis shows that the performance of housing market has been mostly in line with our previous forecasts. In the previous edition, KPMG forecast national house and unit prices grow by year on year by 5.3% and 4.5% respectively in 2024, with the actual growth being 5.1% for houses and 4.5% for units. In this new report, KPMG forecasts that house prices will grow by 3.3% in 2025 and 6% in 2026. KPMG anticipates unit prices will rise faster than houses over the next 2 years as they offer a more affordable entry point into the property market, amidst the affordability crisis growing by 4.6% in 25 and 5.5% in 2026. Now, this is looking at a very, very short-term time frame, and this is very important that you understand this, because while in the short term we might see that catch-up play with units, you need to be comfortable that if you're going to get into an asset in any location, you have to be thinking about how do I hold this for at least 5 years. Over the last couple of years, because some areas have absolutely exploded, you can almost justify why flipping a house now would make sense. You would have bought at say $250K in 2020, you could probably sell the same house close to about $400,000 to $450,000. In that case, I understand you're taking chips off the table and maybe you need it for something else. You pretty much did like a whole cycle, but just in a couple of years. Now I'm a little different. I only sell if I really need to sell, and otherwise I'm buying and holding for a long time because the transaction costs just don't make sense. And if I want to get into assets, I'm buying something that is quality that I can hold for a long time, but I need to keep my strategy fluid so that I don't just hold something that I think is going to go up and actually doesn't. That's why there's this saying, which is you make all the money on the way in. So if you purchase well, you should be okay. Now, although KPMG is coming out and suggesting units might grow faster over the next couple of years, you need to understand that they're talking at a very, very high level. In fact, I have units in my own portfolio and some of them do really well. In fact, some of them actually outperform the houses in some other areas. This will all depend on what data sets you use and how you go and approach buying the right property at the right price. Because even if you go ahead and buy a house in a really high demand area, if you end up paying or overpaying by $20,000 or $30,000, it actually means that most of your gains for the first year or two mean absolutely nothing. And that's where I steer away from things like house and land packages, which are largely inflated by commissions that are never told to you by developers. And it means that even though the area might be really good, you just might be purchasing something that's worth $650K for about $700K. And that means although it's growing, you technically are still in negative equity territory. It's backwards. What I want to do is get into the market, buy under market value and get into warm spots. That is going to be how I approach investing in general because it's worked for me over the last 11 or 12 years and it's worked for over 1,000 clients that we bought thousands of properties for. If you're interested in knowing how to move with speed and have a team behind you rather than you having to individually contact agents, you want to go in there with the Avengers team, right? The best in the business. Then go ahead and look up search property on Google. You'll find a bunch of reviews, but you'll also be able to book in a free call as well. Now, here's what they look at in terms of city by city price growth forecasts over the next 2 years. What we can see is the houses on the left and units on the right. And what you're going to see is the trend where in 2025, they expect that the price appreciation won't be as high as in 2026. And that applies to both the houses and the units. Now, let's take a look at the bigger markets like Sydney and Melbourne. They're actually expecting Melbourne will outperform Sydney and will be the second best performing market across all of Australia, equal with Canberra. So that's a pretty big surprise. You can see Perth there, which is a complete hotspot, and a lot of people have been purchasing there. We started purchasing there about late 2020, early 2021, and I can tell you now those clients are very, very happy. What's up? Now, I have gone on to say that I still think that the Perth market or areas in Western Australia still have a lot of growth to do. But you've got to think about how you're building out your portfolio. It's not just, how do I just purchase my next one? You have to be thinking about the next few moves. I read a book recently, it's by Patrick Bet-David, which is Your Next 5 Moves. And although he talks about that in the context of business, I think it's very relevant to you in your investing portfolio. Because investing in an asset like real estate and having a portfolio of properties needs to be treated like a business. So just like you go and say, okay, I need to hire for this role, instead of just thinking about this role, think about what you're planning to do over the next 3 to 5 moves, and that will then ensure that you find the right person up front. You may not want to hire someone junior, you might want to hire someone who's got the potential to lead a team rather than just finding someone to plug a hole. Similarly, when you're purchasing property, you're not just purchasing something for the next 2 years. You're looking at, how do I purchase something that's going to give me what I need in my portfolio to continue growing year on year? And so when we look at this, we can see the best performing market according to them will be Perth at 4%. And in 2026, they will increase the rate of growth to 4.6%. Now that won't be the highest. What we're going to see is Sydney and Melbourne return to becoming the king and queen of the Australian property market. They're expecting Sydney to grow as much as 7.8%, Melbourne by 6%, and that would be your number 1 and number 2. Brisbane follows that at 5.6%, and then you've got Perth at 4.6%. I suspect that this is on the expectation that we're going to see rate cuts, and we're going to see a lot of them happen quite often in 2025 and potentially in 2026. And the reason why this is important is because interest rates really affect a lot of the properties in the less affordable markets where the prices are higher. So naturally, if you're seeing that in Sydney in terms of growth in 26, it just means that KPMG is expecting that maybe we get a couple of cuts in 2025, but the majority of cuts and the effects of those cuts will come in 2026. If we go across to units, you can see that in year 1, which is 2025, you've got Sydney as the king at 5%, equal with Perth at 5%, and then you've got Melbourne at 4.7%, and then you've got Adelaide at 4.6%. In year 2 though, it becomes very interesting. What you see is in Melbourne, a 7.1% increase being the top performing market, and then it's followed by Sydney at 6.1%. You've also still got Perth performing really well at 5%. Now to just put this into context, because we hear these numbers and we're like, yeah, I don't know, does that mean much to me? Well, if you're purchasing a $500,000 property, and yes, we're not going to find that in Sydney, probably not going to find it in most of these areas, but you look at regional hubs, you look at smaller capital cities, right? And you look at those markets and you say 500K, and if it grows by say 4% in year 1, being 2025, that means that 500K property has generated for you $20,000 worth of net equity. Now what happens is in year 2, let's say it grows by 5%. Your $520,000 property will go up by another $26,000. So by simply being out of this market, expecting what KPMG thinks is going to happen, you would then be finding yourself having a property bought now at 500K be worth more than $550,000 over the next 18 to 24 months time. To put that into context, you would have to be making anywhere close to about $80,000 a year from your active income to generate those sort of returns. Now, why I like real estate is because I can go ahead and purchase property, I can let it sit there and just have it compound over time. There's going to be years where it doesn't grow as much, some years it might even go down. But over the long term, I'm in an asset that's going to continue growing, and it's going to outpace inflation, and it's going to outpace me investing into ETFs and shares because I get leverage. And I'm okay to accept the risk that I get with leverage, but also have the right framework in place to be able to manage such a large portfolio with property managers and people I can trust. Now let's take a look at what happens to the rental market, because the rents have started to slow down. That doesn't mean that rents are starting to fall. In some areas that might be the case, but what I'm referring to is the pace of rental growth. And that is actually a really good sign when it comes to the rental crisis. Now we should see this ease a lot more over the next 18 months, because as we see interest rate cuts, we will see a lot more people go into the market to purchase property. But if we do see property prices increase, it might be a leading indicator to what happens with rents moving forward in the following 18 months. Now rentals, for non-owners, there may be some relief. While rental price growth moderated slightly from its peak of 7.8% in March 2024 to 6.7% in September, the strong rental price growth figures continue to reflect low vacancy rates and a tight rental market. KPMG expects annual rent growth will be around 3.5 to 4.5% over the next 2 years based on its projections for new dwelling completions and Treasury's population forecasts, which have normalized from the recent migration boom. Brendan Ryan said a downward shift in rental prices will help with restrain property growth. The high rents in recent years have pushed more renters to look to buy instead, which has added to demand and hence prices. This is one of the factors we see contributing to a more balanced and sustainable rate of price growth over the next 1 to 2 years, and more aligned with long-term averages. But the lower rates established by the end of 2025 will see improved sentiment among buyers and investors, maintaining market confidence and seeing prices rise again in 2026. I would love for the entire industry to move away from houses versus units. A lot of people, just even at your local barbecue, are going to say, well, I think units are better than houses, or houses are better than units. Now, historically, yes, if you looked at averages of everything, houses outperform units. But it's not that simple. You have to go deeper into that. You need to look at specific locations, you need to look at which type of units, because a unit in a mass development is not the same as a unit that has waterfront views that other houses will never get because of their geographic location. So that's why you need to consider that each suburb has a demand by the renters, investors, and owner-occupiers for a larger home, for a smaller home, could be a townhouse, could be units. This is why if you want to become filthy rich with real estate, you want to go out there and purchase multiple properties, have this machine that Ravi talks about growing in the background. You can't just do that with average properties, because we know average properties, say it with me, get average results. And you're not here to get average results. What you want is substantial results, because financial freedom is going to be a 1% life. And if you want the 1% life, you need to do what the 1% are willing to do. And they think differently. I made this video right here, which I think you need to check out next, because it talks about the rules of being filthy rich. I hope you guys have enjoyed my insights. If you have anything to add to this, definitely let me know in the comments down below, and I'll be sure to consider that in my next video. Thank you so much, and subscribe if you haven't already. We're trying to get to 100,000 people in this community. I hope you guys have enjoyed this video. I'll catch you guys in the next one. Thanks, guys.